This video is sponsored by Blinkist. Click the link in the description below or scan the QR code on screen to get a 7-day free trial plus 70% off a Blinkist annual premium subscription. Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin, with us seeing the recent rise and fall of GameStop once again, and discussions resurfacing around market fairness and even market manipulation. I want to take some time to cover a topic that often comes up with these stories of nefarious actors trying to hide their intentions. It's a term you might have come across, but most people have never heard of it, despite the fact that it does play a pretty big role in how stocks are traded on the market. And that is the concept of dark pools, which more or less is a private market where institutional investors can trade exchange-listed shares. And with a name like that, naturally comes across as a pretty ominous and even treacherous place where dealings go down. So I want to post a video explaining exactly what dark pools are. And to be perfectly upfront so as not to mislead anyone here, while the term itself sounds very mysterious and sketchy, dark pools are just a type of off-exchange market, with it even sometimes being used synonymously with off-exchange trading itself. And for most long-term investors, they don't really matter. It's not to say they aren't important, but most small investors won't ever deal with dark pools directly, which is in part why a lot of people don't know about them. Even myself working as a portfolio manager, not something I ever deal with, but it is nonetheless an area that has attracted a lot of controversy, and they become incredibly popular for trading stocks in the United States. With, according to NASDAQ Canada CEO Dan Kiesis, dark pool trading capturing 40% of average daily market share in 2021. With that figure, albeit being lower in Canada at just 7% due to a, quote, higher standard of regulation, which might tell you a little bit about why dark pools have been controversial. So let's dive right into dark pools and shine some light on this obscure and ominous topic to explain what dark pools are, the controversies around them, but also what they aren't, since at times you do see dark pools used as a sort of filler term for, again, some conspiracy theories. We'll start off with a definition or explaining what exactly dark pools are, since the term is sometimes used synonymously with, again, what's called over-the-counter trading or alternative trading systems. Basically, anywhere a stock trades that isn't a public exchange. But technically, dark pools refer to a specific category of alternative trading systems where institutional investors can trade exchange-listed shares, among other securities, without first routing the shares through an exchange. And they can only typically be accessed by large institutional investors, meaning that small retail investors have really no direct access to dark pool markets. And the defining feature of dark pools, as the name sort of suggests, is that orders submitted in this market are obscure or hidden until after the trade is executed, not just from the public, but even from other dark pool participants, meaning that if you go to buy shares on a dark pool, you'll have no idea whether there are any sellers of that share. You kind of just have to submit your order and hope it gets filled, which is very different from how exchanges operate. If you submit a buy order to your broker and that gets completed on an exchange, your pre-order information or the pending information for what you're looking to buy is available to everyone, including whether you're looking to buy or sell, the number of shares you're looking to purchase, and the specified price. With dark pools, again, these details are kept private, even allowing for a degree of anonymity. Now, based on all this and what we've talked about so far, probably sounds like a pretty shady place to do business. But the thing worth highlighting is that outside of being legal in the United States, dark pools have been around since at least the 90s and are often run by exchanges and broker-dealers themselves. And it is still a regulated space, albeit less regulated than public exchanges, with all US trades for exchange-listed stocks still being reported to FINRA. And the main thing is that it's the pre-trade or the pending order information that remains hidden. Once the order is executed, once a buyer and seller has been matched and that trade has occurred, the stock has changed hands, that information does show up on the consolidated tape, which you can think of as the database or receipt of all trades occurring on the market. So at that point, the public can see what trades have occurred on a dark pool. They do still get reported in that way, albeit at times with a bit of a delay, which we'll touch on later. And as mentioned earlier in the videos, dark pools have become an important part of market trading activity, with them being really popular among hedge funds, but even other large institutional investors like pensions and mutual funds, even at times brokers that you yourself might be trading through. In fact, when we talk about payment for order flow, which I'll leave a link in the description explaining that concept, these are the venues trades can be routed to for payment rather than public exchanges. So they've become pretty ingrained in the operations of the stock market. Still, given everything we've covered so far, it might feel like dark pools would only ever be used for nefarious reasons. So why would someone use a dark pool if not for something dark, ominous, and mysterious. Well, one of the biggest advertised reasons for why people use dark pools is that it helps people carrying out block trades, which just really means large trades for a given stock, without significantly moving the price of that position until after the trade is completed. You see, in public markets, trades themselves are considered a type of signal. If a trader notices that a mutual fund is dumping a large position, if they have this pending order to sell a bunch of a given stock, they'll naturally interpret that as meaning that that mutual fund might have information about that company that will lower the price in its future. And before that pending order gets fulfilled, given that it's such a large order and likely won't be able to be filled right away, other traders might lower the price of that stock to digest this information or perhaps even take advantage of this sell, again, before that trade gets executed, meaning that the mutual fund will realize a lower price than what they were perhaps hoping for. If a stock is trading currently in other transactions at $10 a share, their large order might only see an average fill price of, say, $9.80. In other words, large sell orders can actually hurt the price of the stock before they get completed, meaning that the seller is on the receiving end of that negative return. With dark pools, however, again, this pre-trade information is not shared among market participants, meaning that it itself won't inherently move the stock price before that share sell gets completed, meaning that the seller might have a chance of completing that large $1 million or million share sale before the stock price moves lower. Essentially, they'll submit their million share sell, it'll get matched with a bunch of smaller buys, potentially within the dark pool, and the traders of those individual trades will know that they traded that small amount of shares, but won't be aware that there's a large seller that they can try to take advantage of. So you can easily see the benefit there for large investors, which is why dark pools are so commonly used by what are called buy-side institutional investors, such as mutual funds, pensions, and the like. They can submit their massive orders without the market moving against them before they complete those orders. Secondly, in addition to the first point, traders can actually get a better fill price-wise when it comes to dark pools versus an exchange, lowering their execution cost. With an exchange, for example, you have what's called the bid-ask spread, which is the highest price that buyers in the market for the share you're selling are willing to pay, and the lowest price that sellers are willing to accept for a given stock. So while we often reference a stock's market price, this isn't necessarily the price you can get in trading a stock. The price for buying a stock will always be slightly higher than the price for selling it in any given moment, with that difference being called the bid-ask spread. Dark pools, however, can complete trades within that spread, which might not be a big deal for small retail investors where there might be a penny difference between the two prices for especially larger traded stocks. But for larger traders who are selling or buying millions of shares, it's a bigger deal, with some of those savings coming from the fact that, again, these trades bypass exchanges and can save on some of the fees associated with that. Thirdly, dark pools can offer an additional source of liquidity to the market. While exchanges are pretty liquid, the thing with dark pools is because companies aren't typically afraid of letting their orders pend, given that that information isn't inherently going to be moving the markets, that can help with the buying and selling of shares. And finally, dark pools can help traders avoid trades with counterparties they might not inherently want to deal with, such as, for example, high-frequency traders, which, to oversimplify, since again that could have its own topic, high-frequency traders are effectively people who have built out infrastructure and technology to trade faster than others in the market, and through algorithms are able to pick up changing market information and price changes so quickly that they can actually trade on that information before others in the market are able to react. And on exchanges, they can be a real bane for large investors and traders. But again, because dark pools hide that pre-trade information, it does help mitigate some of these issues. In fact, depending on the structure of the dark pools, some will go so far as to try and actively promote exclusivity to push out any traders that exhibit this sort of behavior, or perhaps are trying to carry out predatory trading. Although we have still seen issues with high-frequency traders in dark pools, which we'll touch on. So these are the main reasons why large institutional investors might want to use dark pools and hide that pre-order information. While it certainly comes across as nefarious, and certainly, don't get me wrong, financial institutions don't have an amazing track record around that kind of stuff, but the real intent is to avoid having those orders taken advantage of, or to, again, move the stock price against their favor. Still, it's not a perfect solution, and there are some drawbacks to using dark pools for institutional traders, with the biggest one being that the same anonymous trading and privacy can make it difficult to find a counterparty for your trade. Again, because you can't see who else is in the dark pool, you're kind of just throwing trades into the void, you really have no idea of knowing whether there are buyers or sellers with the necessary liquidity to fulfill the other side of your trade. And because of that, large trades can take longer to be completed in a dark pool than on an exchange, which naturally comes with an opportunity cost, especially when you come with shorter term traders and when positions are more volatile, when they're moving from second to second or minute to minute. A second drawback is that even though dark pools were seen as a way of avoiding high frequency traders, they've still managed to take advantage of the dark pool structure. You see, some traders will use a strategy called pinging, where they submit smaller orders for a given stock to get an idea or feel for if there's buyers or sellers for a given position and the price is being fulfilled, and then look to use that information to, again, abuse those trades. And thirdly, as mentioned, dark pools are less regulated than public exchanges, which might sound like a benefit to nefarious traders and, say, short sellers looking to obscure their information. But in the past, it's actually meant that traders in the dark pool have actually been abused by dark pool operators. Without seeing examples of dark pools misleading institutional investors on how trades were priced and fulfilled, blatantly sharing or trading on supposedly confidential customer order information, and failing to protect their investors from predatory traders, even at times giving these traders special access to their platforms or order types. So we've seen a lot of companies charged and fined for effectively abusing their clientele. And those are only really the issues faced by participants in dark pools. As mentioned, there are also a lot of public criticisms of how dark pools sit in the larger ecosystem of the stock market. With the first main one being that with dark pools only being available to institutional investors, it does inherently feel like an unfair advantage given that retail investors don't have access to these same markets. I know it is worth highlighting that the average retail investor or even trader probably wouldn't see much of a benefit to using dark pool trading. They don't face the risk of moving the market and really being targeted the same way as, say, a market maker by high frequency traders. But regardless, when there's a tool in the market that one party gets and the other doesn't, that's going to be perceived as unfair and an issue, especially given that many would argue that large buys and sells should move the price of the market against the large buyers or sellers, given that that's relevant information. A mutual fund dumping a stock is relevant to other public traders of that stock. But when that's carried out in a dark pool, it doesn't immediately impact the price of that stock, meaning that people could be, say, buying up the position right as it's being dumped by a large investor. Which actually brings us to the second main criticism, which is that dark pools actually tend to base the prices for their execution off of the lit market prices and the bid-ask spread and things like that, without themselves inherently contributing to the price discovery process until after their trades are executed. So while dark pools aren't helping with market efficiency, they are sort of taking advantage of the data being reported by public exchanges, which kind of disincentivizes public exchanges who are possibly losing volume to these dark pools to make that information more public. And the stealing of volume, for lack of a better word, from these public exchanges can impair the price discovery process and market efficiency if it occurs to a large enough degree, which means that the prices we see for stocks might be more departed from, say, their intrinsic value. And we could actually see a widening of bid-ask spreads, meaning that there's more of a price for trading stocks in public exchanges. Thirdly, while FINRA does again collect information from OTC markets and trades on dark pools are typically reported within 10 seconds of occurring, there are instances where the reporting of that information to the consolidated tape can be delayed in a substantial way, with late orders being reported early the next day, and some orders known as signature prints, which typically only involve certain types of ETFs, seeing the reporting delayed by up to 24 hours when the trades are carried out through a European trade desk. This again doesn't really matter for long-term investors, given that the information shows up at some point, but for people who are more short-term oriented, like day traders, it could be important. And just overall, because there's less regulation here and more obscurity around trade information, it just feels like there's more room for shenanigans. Now, in response to some of these criticisms, we have seen some actions by regulators to try and crack down on dark pools and make them more transparent. In 2018, for example, the SEC voted to introduce new disclosure rules for dark pool operators, with them now needing to file public disclosures around how they operate so that investors who might use a dark pool can better judge the service they'll receive and whether there are any real or perceived conflicts of interest. With, for example, the disclosures including whether there are different tiers of service and the volume the dark pool sees. Meanwhile, in Europe, we've seen a much bigger crackdown on dark pools, with the European Union's MiFID II rules really restricting dark pool activity in a push to try and get more trading activity onto lit exchanges. But still, dark pool operations remain pretty unfettered in the United States. Now, it is harder to prove that dark pools are being used to, say, manipulate markets, but of course, if there is a way to abuse the markets, some market participant will find a way to do so. But with short selling specifically, it is worth highlighting that dark pools don't allow short sellers to hide their trades. Everything is still reported and relatively quickly. It's only really that pre-trade information that remains hidden. There are still short position marking and position reporting requirements. You can see estimated short interest figures inclusive of dark pool trades, albeit these are very imperfect figures. And there doesn't even really seem to be an inherent advantage to shorting on a dark pool versus an exchange. In fact, one research report actually found that short sellers often look to trade on public stock exchanges rather than dark pools, given that trade-off in liquidity. Now, of course, there is always a chance a market player is doing something fishy and illegal with dark pools, and there are valid concerns around public transparency here. But again, when it comes to dark pool activity for exchange-listed shares and what regulators see, it's not really as opaque as it might appear from the outside. And finally, while you might again have this image of dark pools being used by these whale traders who are trading massive amounts of shares away from the public eye, the average trade size on dark pool trades has actually fallen quite a bit to, in the most recent quarter, just around 100 shares a trade. Meaning that while there might be larger trades and traders say breaking up their trades for a given reason, something often referred to as an iceberg order, because you're only showing a small order that's part of a larger trade, it doesn't seem like they're actually being used as often for those massive large block trades that we might expect. Still, with the other implications and criticisms around that taking volume away from lit or public exchanges, still itself comes with some problems, but just some final points worth clarifying around how dark pools are used. Now, with all this, you might be wondering, Richard, how do I jump into the dark pool? Where do I see this information? Well, again, unless you're a day trader or someone who really focuses on that kind of style of trading, there's really no benefit to a long-term investor analyzing dark pool trade volumes and things of that sort. But if you are interested, you can actually see dark pool trade information on FINRA's website after a 2-week delay for National Market System Tier 1 stocks, which are publicly traded stocks that are part of the S&P 500, I think the Russell 1000, and exchange traded products. And there are some services that offer access to that consolidated tape feed that will highlight when a dark pool trade has occurred. Although there you have to be careful with how those trades are identified. Not all systems are the same. But again, when it comes to smaller investors, there's not really seemingly as much of a benefit. And especially if you're a long-term focused investor, while this stuff is important to markets overall, it is certainly interesting, I don't know if I would argue there's much value in, say, someone who's looking for a 10-year position to analyze dark pool information. So anyway, that is dark pools in a nutshell. Their benefits for users, their cons, their controversies, and a bit of information about how you can see dark pool information. Before I sign off, I do want to give a quick thank you to today's sponsor, Blinkist. As maybe demonstrated with this video, I'm someone who really enjoys reading and really getting into the weeds of more complicated financial topics. Flash Boys, for example, was actually a great book by Michael Lewis, same guy as The Big Short, that talks about dark pools and high frequency traders and things of that sort. But given my long to-read list in finance specifically, I don't often find time to dive into other topics, which is where I really see Blinkist coming in. They've been a longtime partner of the channel, and if you aren't familiar, they're an app that offers summaries for over 6,500 nonfiction books, breaking them down into digestible and important bits, which you can either consume by reading the summaries or listening in, which I much prefer myself, given that I like to use it while I'm doing chores, so that I'm getting things on my to-do list done, while learning something new and interesting. For example, I recently listened to the Blinks for the Federalist Papers, which, yes, refers to the 85 articles written by James Madison, Alexander Hamilton, and John Jay. That would lay the groundwork for the US Constitution. Something I would have never read on my own time, but I found it really interesting to hear the arguments central to the articles, such as, for example, that protecting property rights was seen as being as much of a priority for the government as protecting citizens themselves. Overall, it's a really great way to learn something new, whether it be to satisfy your immeasurable curiosity for the universe, or you're just trying to learn something more actionable for your career or to try and learn a new skill. And thanks to the special Blinkist Memorial Day sale, you can get 70% off a Blinkist annual premium subscription. So you can click the link in the description below or scan the QR code on screen to get your 7-day free trial and take advantage of this awesome deal. So thank you, Blinkist, and thank you guys for joining me today. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on dark pools. Anyway, thanks again for joining. See you in the next one.